Assalamu alaikum. Good morning to everyone. Welcome to my YouTube channel. I'm Engineer Salman Ahmed Khan, and today I'm going to present you about the commercial terms that we use in the procurement while doing the purchase agreements with the suppliers. And these commercial terms are very important while you're doing the purchase agreements. With the suppliers or the vendors around the globe from any country or region. And uh, and yes, in this video, I'm going to talk it about and one of the important terms in doing the agreements between the suppliers are the Incoterms. Incoterms basically defines the responsibilities, cost, and the risk between the buyers and the sellers. And then the letter of the credit, which is one of the secure payment method, ensuring safety for both the buyers and the sellers. And then there are the commercial documents. These are the essential documents that facilitate smooth clearance and the payment methods between the buyers and the supplier. And in between, there is a procedure of the landed cost, a procedure or the costing, which has been done by the buyers at the procurement side to know the total cost of the goods, including the freights, duties, taxes, and the other charges, along with the custom duties. And custom duties means the taxes imposed by the custom authorities on the imported goods. So these terms or these on these topics I'm going to talk about in this presentation. And before I start, I about uh, my on the main topic. It is also very essential to understand the basic definitions of the import and the export. Basically, this is the foreign trades. These are the kind of the foreign trades that are being done through the supply chain via the logistics. As I have a very detailed presentation and session on the logistic management in my previous video. So while doing the foreign trades in the globe, there are two basically things which are being done. The number one is the import. When we talk about the import procurements, it means that it's about bringing goods and the services from the another country towards the home country. And when I talks about the export, it means that selling the goods and the services from the home country to another country. So we often have heard about the trade balance when we talked about the global trade. So normally, when you have a greater exports, it's mean that you have a positive impact on your financial checker or your financial side. But if you have greater imports and less in exports, it could have a negative impact on your national checker or your on your national assets. So these things has to be balanced. So let's start with the import procedures and the procurement. Um, in import procurement procedure, the procedure is almost same. You raise the purchase acquisition, which is actually raised by the planning section side. And when it is actually received to the procurement, procurement does the strategical sourcing and send the RFQs in the market to find out the right supplier with the right pricing, with the right quality, with the right quantity. And then after that, they do the quotation evaluations based upon these scenarios, based upon the technical evaluations. And after that, they issue the purchase orders. While issuing the purchase orders, when I talked about the import procurement, it's mean that here suppliers don't give the quotation. They gives a kind of a performer invoice. They actually give a performer invoices mentioning the prices, and obviously the Incoterms that they are using in the performer invoices in the purchase agreement at the initial level of the stage. And after they issue the performer invoices, they issue the commercial invoice, based on the payments, based on the payment terms and the volume of the payment. For example, if the payment is more than 10,000 US dollars, it means that you have to process through the letter of the credit. Letter of the credit is a secure payment method, as discussed earlier in my previous slide, that here you have to involve the banking channel, and bank actually open this letter of the credit. And of course, I'm going also discuss this in my presentation later on. And then after that, you actually, the supplier especially books the shipment forwarding agent or shipping line who will move that shipment from the country of origin to the point of the destination, along with the commercial documents. And those documents are being scrutinized in the customs after paying all the valuable taxes, the GSTs, and all those things, and then actually move towards the transportation, towards the destination warehouse. And then after that, you actually retired those documents based on the commercial documents which you receive from the suppliers. That could be the packing list, commercial invoice, bill of landing, insurance policy, and etc. So the parties involved in these procedures are the importers, the buyers, suppliers, which are at the export side. As I mentioned earlier, that buyer is at the import side and supplier is that export side. The banking channel, which will be issuing and advising on the letter of the credits or in the advance payment or on the foreign reserves. Also the freight forwarders, the shipping lines companies, the insurance companies, the custom authorities, and the transporters. Now, the important key things to consider while doing this is that you have to make sure that your all key documents are streamlined and are well managed and well communicated between all these stakeholders, or you can say the parties involved in that. Because if any document has been missed, there could be higher penalties. And the important point is to consider is to select the Incoterms. You have to define the responsibilities among the buyer and the sellers, calculate the landed cost, ensure the correct HS codes, classifications to avoid delays and the penalties, comply with the import regulation, manage exchange rate risk and the payment securities, track your shipments, and have a strong communication with the banking channels at your country of origin and towards the suppliers, and evaluate supplier performance for the continuous improvement. So this is about from the import procedure and the procurement. Now at the export procedure side, export procedures cover all the commercial documents, regulatory and logistical steps required to move the goods legally from the exporter country to the importer country in accordance with the agreeable terms. And it starts from while in import, we saw that the process starts from raising the PR and then circulating the RFQs in the market, and you actually evaluate the suppliers and make a commercial or purchase agreements with them. At the export procedure side, the supplier receives the PO, the purchase order based upon the agreeable Incoterms, and also actually make the liaison with the buyer's bank based upon the agreeable payment terms through the letter of the credit or the advance payment terms. And then they absolutely also ensure the export compliance check and prepare for the goods based upon the factory acceptance test, the manufacturing, make sure the quality is not being compromised, and do the proper verification, and prepare a commercial documents required for the freight forwarding agent or the carrier booking to transmit to transship that shipment from the origin to the destination. And once that reach, you actually focus for the export declaration. Once it has been declared, there has been a procedure of the custom clearance, and then it actually shoot through the buyer's sites, freight forwarding agents or the custom agents. So this is also very important part. And I have been using the term landed cost. So this landed cost procedure has to be done at the buyer side while you are making the agreements with the suppliers who could be situated, or their companies could be situated in any parts of the country, either in America, either in Africa, Central Asia, Europe. So the landed cost is basically the total cost of the product, including all the expenses incurred to bring the goods from the supplier towards your final destination. Now, what are the components of the landed cost? Um The cost components are the product's major export price, the price of product from the supplier's premises, and then origin inland freight, the transport from supplier factory to the port, and that has to be paid by the buyer, export packaging and handling, export duties, maritime insurance, import taxes, custom clearance, value-added taxes, the handling and the terminal charges, other local charges. So these all kind of the cost has to be considered while buying from the supplier's premises. And the landed cost formula is very simple. Uh, uh, it's not like not complex. It's like you actually find out the landed cost based upon the X work price. For example, the X work price is about 10,000 US dollars, and then you add the origin inland freight, export packaging, handling, export duties, taxes, the ocean freight shipment charges, marine charges, custom duties, value added taxes, custom clearance charges. And of course, these charges could be vary and depends upon country to country tax regulations. Like in my country, Pakistan, GST is 18% on the goods, and on the service it is 15%. The custom duties could be around 2 to 3% or 4%, depends upon the HS code. The freight of charges of the ocean or the air side, whatever the mode of the transportation has been selected by the buyer in accordance with the consensus from the supplier side, those costs could be vary. So once you actually calculate all those things, you actually find it out the landed cost of that. So steps to find out the landed cost. Step number one is that X works price from the supplier. You identify the Incoterms to know buyer responsibilities and the seller responsibility. List all components from the origin to your warehouse that will be involved in the costing of that. Collect the actual quotes rates of each components that I have mentioned, which could be vary. Calculate all cost in the same currency, sum all cost to get the landed cost. Now, X works price, if for example the price is in the US dollars and your currency is the Pak rupees, or you deal in dirham, you deal in real, you deal in dollars, Australian dollars, etc. So you convert that currency into your exchange rate and then add the cost of the component of the landed cost step by steps, as I mentioned earlier. So if the price per landed cost is 16,000 US dollars, so it means that it is the cost of the one unit. And then you can actually calculate with the total quantity that you actually required for the same. So important point to consider is that landed cost helps in accurating the pricing, budgeting, and decision making. While you are doing the budgeting, capex budgeting or opex budgeting to manage your cash flows, this cost helps a lot. Custom duties and taxes vary by country and the adjust code, as I already mentioned. Exchange rate fluctuate affects the landed cost, and always keep buffer for unexpected charges. So you have to consider that while you have to incorporate this in your purchase order once the shipment has been received. So in terms of the HS code, I was talking about the HS code, harmonized system of the nomenclature. HS code is basically a global standardized system of the names and the number used to classify the traded product. It is used by the custom authorities worldwide to determine the import-export duties, maintain trade statistics, and regulate the international trades. So HS code is basically used for the custom clearance, determine applicable taxes, trade statistics to collect and analyze the international trade data, helps enforce import-export regulation quotas in the trade and the trade agreement as well, and actually classify the product. So now the structure of the HS code is like this. The HS code is a 6-digit international code. Many countries could extend it further for their national use. One, two, the first two digits determine the chapters. The three, four headings determines the next two digits, which actually defines the heading. And last five or six determine the subheading. So if there is a 7208.39, 72 defines the chapter, which is the iron and steel. For example, I'm just quoting the example. 8 could be the heading. Iron and steel is the category. 8 is the flat product of the iron and the non-steel. 39 could be the subheading, other of the thickness of the 4.74, determining that what is the actually specification of that product. So Based on that, you actually defines the custom duties in that, and it stands for harmonized system of the nomenclature that you use for determining the custom duties tariff. Now, I have been mentioning and talking a lot about these things. So this is overall the comparisons of that. Incoterms defines the responsibilities, cost, and the risk between the buyers and the sellers. It contains the as follows: free carrier, carriage paid to, carriage insurance paid to, delivery at the place, delivery duty paid, free on board cost and the freight, the letter of the credit, and in the letter of credit shows the seller of the payment provided they comply with the terms and present the required documents. So, and obviously the commercial documents. So these three are very much important in the commercial procurement. You have to, um, have to closely follow up with these scenarios while doing the commercial agreements with the suppliers. And to go into the detail of these scenarios, I talks about the Incoterms in the transportation. X works is basically the Incoterm. Exporter is supposed to be ready their goods at loading places such as factory and the warehouse. So X work price is a price which is a factory based price, and the exporter has to ready the goods at their premises, warehouse or the factory. Free carrier is the seller obligation to hand goods over to the first carrier at the name place. Buyer assume the risk and cost of any further transport executed free on board. Exporter fulfill the delivery responsibility when the good pass the board of the vessel. CFR is the cost and the freight charges. It actually in this delivery term, the good is delivered to buyer as a paid freight cost, and the carriage paid to in this delivery term, the cost and export procedure exported country is completed by the seller. Similarly, there is a cost, insurance, and the freight. In this delivery term, the cost and export procedure at the exporter country is completed by the seller. The CIP is the carriage and insurance paid to seller. In this Incoterm, seller must deliver the goods at designated carrier or other person designated location, and the seller must pay the transportation cost. DDP is a delivery duty paid. DAB is the delivery at the place, and DAT is the delivery at the terminal. Now the difference is that when I talk about the delivery at the terminal, it means that the goods are delivered at the terminal, and now it's the duty of the buyer to do the remaining custom duty procedures. DAPS means the delivery at the place. In this delivery time, export is supposed to deliver the goods at which the unloading is placed stated by the buyer. So here the exporter has to clear all the custom duties and all things and has to put it at the buyer location. Now the DB is the delivery duty paid. In the delivery duty paid, exporter is supposed to attend the good in which it is stated that buyer's country as a custom procedure has completed. So delivery duty paid means that the buyer shipment will be sent by the seller by fulfilling all those custom duties. Now, this is the comparison of overall Incoterms, that what are the duties of the seller, what are the duties of the buyers. And of course, you can see that comparison later in my presentation on my video as well for your references. If you are stuck some here, you can see these differences, the obligation and the charges, either it is upon the seller or the buyer. So these are the difference of the responsibilities if you choose the Incoterms while doing the purchase agreements. And this is the letter of the credit. The next slide is about the letter of the credit, which actually I have talked about a lot in my presentation. Uh, Letter of credit is a commitment issued by the bank on behalf of the buyer or to the seller that the payment will be made provided the seller comply with the terms and conditions of the LC and present the required documents. So this is a kind of a surety by the bank on behalf of the buyer to the seller that the payment will be made provided that the seller will comply the terms and condition of the LC and present the required documents. So This is one of the most important side of the LCs, and there are different types of the LC, irrevocable LC, which cannot be changed or cancelled without the consent of the parties. And normally, this is actually adopted by all the party. Irrevocable LC can be changed, cancelled by the issuing bank at any time. Confirm LC confirmed by a second bank, adding it's a guaranteed of the payment. Unconfirmed LC, no confirmation given by the bank other than the issuing bank. Transferable LCs allow the beneficiary to transfer all or part of the credit to the second beneficiary. So this is one of the important part of that, and it is being done by the sales contract. Buyer sellers agreed on the terms of the sale. The buyer applies to the bank for issuing the LCs. LCs are being issued by the bank as according to the documents given by the seller, and then it actually also, after the LC has been issued, has been advised, it actually notified to the seller, and the seller export based on those LC documents which are being shipped. And once they are being shipped, the documents are also forwarded to the banks for the further checks. And then issuing bank verify the document, release the payment to the advising bank, which pay to the seller. So this is how the retiring process is completed in the letter of the credit. And now the documents which are being used in the foreign trade is: number one is the pro forma invoice issued by the seller to the buyer containing details, pricing of the goods, and the terms of the sales. Commercial invoice issued by the seller to the buyer showing the details of the goods sold, value, and the terms of the sale. Bill of lading is basically issued by the carrier. Packing list, a freight invoice, insurance policies. Packing list prepared by the seller show details of the packing, number of packages, weight, and the size. Freight invoice issued by the forwarder or carrier to the shipper for the freight and the related charges. Insurance policy issued by the insurer to identify against loss damage to the goods. Now, this is the pro forma invoice. There is no commercial liability with regard to the exporter importer used to present an offer. As I said in my earlier presentation, that in import sites, in import procurement, normally seller presented the pro forma invoices, mentioning the currency, payment terms, total pricing, unit price, country of origin, description of the goods, and buyer name, address, and the seller name, and all those things. Now this is the commercial invoice template, which actually buyer must pay the total invoice of the goods at the indicated date on the commercial invoice, which contains the description of the good, delivery terms, Incoterms, country of origin, net and the gross weight, packaging number, unit price, total price, HS code, and the payment terms. The bill of lading is another important document, which is a key document in the international trade. A bill of lading is a vital document in shipping and international trade. It serves as a receipt for goods shipped, a document of the title, or we can say a contract between the carrier and the shipper. So the bill of lading is basically document of a title, a receipt for shipped good, and a contract between a carrier and a shipper. So this is also very much important document. Packaging list, or we can say packing list, is a document prepared by the seller which contains detail of the goods packed in each package loaded into the truck or container for the shipments. It helps in identifying your required shipments, or you can say the materials in the container or in the pack or in some kind of loaded trucks for the custom clearance and smooth delivery of the goods. The key information included the exporter name, a description of the goods, unit weight, total net, total gross weight, total package, and the HS code. Now, this is also the freight invoice, which is issued by the forwarder to the exporter for the transportation of the goods. It serves as a request of the payment for the freight charges for moving the goods from the point of origin to the point of destination. Now, this is the inspection certificate, which is actually attached by the supplier. It certifies the condition, quality, quantity, and the compliance of the commodity, especially this is actually incorporated with the major raw material products or the equipment at the point of analysis or inspection prior to the shipment, which actually ensure that the good comply with the required specification and standard, provide assurance to the buyer regarding to the quality and the conditions. Now, the insurance policy protecting your good across the border is also very much important, since we have a kind of lot of global challenges in form of piracy, in form of the torrential rainfall or global warming situation, which actually changing the weather conditions and rising the sea levels. So the goods are assured for all risks by the exporters or importer according to the international trade circumstance during moving the good from country to another country. So it is important to issue the insurance policy. The delivery term plays a significant role for exporter and the importers. So thank you very much for attending and listening my this video session. I hope you like my this video, and I request you to subscribe my channel. And in my next video, I will be talking about the warehouse management automation. So until then, thank you very much and wish you all the best and have a nice day ahead. Please don't forget to subscribe my YouTube channel. Thank you.